You can find the greatest company in the world, but it can be a terrible investment if you buy it at the wrong price. You know, the one thing that really separates amateur results from professional returns, it isn't what you buy, it's when. So today, I'm going to give you the professional's framework for timing your entry to get the most out of every single dollar.
So you've done your homework, the company's fundamentals are solid as a rock. But here's the catch. Buying at the peak of market hype could mean your money goes nowhere for years. So how do you solve for the perfect entry point? That, right there, is the question that defines careers on Wall Street, and we're going to tackle it right now. All right, here's our game plan. First, I'm going to show you the simple but incredibly powerful three-point framework that pros use. Then, we're going to put it to the test with a live case study on Alphabet. We'll dissect its NG, check the price tag, and weigh all the conflicting signals. And we'll wrap it all up with a concrete strategy you can use. So pay close attention. Look, the market absolutely punishes guesswork. If you want to succeed, you need a system. This is that system. It's a repeatable, three-point analysis that forces you to be disciplined and objective. It's all about building an airtight case before you risk even a single dollar of your capital. Here are the three pillars. First up, we check the engine. Is the company fundamentally strong? And, just as important, is the market actually rewarding it? Second, we look at the price tag. What are we really paying for that engine? Is it a bargain, or is it way overpriced? And third, we hunt for the confirmation. Are there other signals out there that validate our analysis? Or are there big warning signs we need to pay attention to?
Okay, let's put this framework into action. Our case study is Alphabet. We're starting with point one, the engine. We need to figure out what's really driving this company forward. Just how powerful is its momentum right here, right now?
This right here, this is the heart of the bull case. I mean, just look at this number. From January 2023 to November 2025, Alphabet's earnings per share are projected to just explode by over 766%. That's not just growth, that's a statement. It's a testament to their dominance in AI, in the cloud, and just being incredibly efficient. This is the kind of raw power we're looking for in an engine.
Now, a powerful engine doesn't mean a thing if the market is ignoring it. But what we see here is that the market is not only paying attention, it is rewarding Alphabet big time. We call this a momentum cascade. Almost 20% gain in 1 month, accelerating to over 77% in 6. The longer you look, the stronger the returns. This is the textbook definition of a healthy, sustained uptrend. So point one is a definite, clear pass.
So the engine is firing on all cylinders, no doubt about it. But even the best engine in the world can be overpriced. And that brings us to the second, and absolutely crucial step in our analysis, checking that price tag. Are we paying a fair price for this incredible growth, or are we just getting caught up in the hype and overpaying?
Our main tool for this job is the price-to-earnings ratio, or PE. Right now, Alphabet is trading at 29.84 times its earnings. And as you know, a number like that is pretty meaningless without some context. So, let's add some.
Okay, this table tells a really interesting story. Compared to its own history, Alphabet looks pretty fairly valued. And that small 6.6% premium to the S&P 500, yeah, you can easily justify that given its growth. But here's the yellow flag. It's trading at a 35.6% premium to its own sector. So the verdict is clear. This stock is not cheap. We're being asked to pay a premium for quality. And that, my friends, introduces a key risk.
All right, so we've got a world-class engine and a premium, but maybe justifiable, price tag. Now for the final step. This is the one that requires the most professional nuance, confirmation. We need to look for signals that either back up our thesis or flat out contradict it. This is where we go looking for red flags.
And wouldn't you know it, we immediately find a major conflict. On one side, insider buying gets a clear fail. The people who actually run the company, the executives, they haven't been buying. In fact, they've mostly been selling. But then on the other side, institutional buying is a resounding pass. The so-called smart money is piling in. We're talking a massive $4 billion plus stake from Warren Buffett's Berkshire Hathaway. So who do you trust? The insiders running the show or one of the greatest investors of all time? This conflict forces us to dig a little deeper into the other risks. And there are quite a few. You've got an ongoing antitrust case from the Department of Justice. We already talked about the valuation risk. The fact that insiders aren't buying really raises questions about their confidence. And of course, there's always the bigger picture, market risk, competition risk, especially in the super fast-moving world of AI. So, a world-class engine, a premium price tag, and some seriously conflicting signals. It's time to pull all this data together and turn it into an actual, actionable plan.
Our final rating is a qualified buy with caution. What does that mean? It means we have to acknowledge the incredible fundamental strengths of this company, but we absolutely cannot ignore the risks, especially that valuation premium and the lack of insider buying. The potential is huge, for sure, but this is not a buy-at-any-price kind of situation. We have to be prudent.
So now your job is to pick the strategy that fits your own risk profile. For the best risk-to-reward ratio, patience is probably your best friend. Wait for a pullback into that 265 to 280 range. If you're a long-term investor, dollar-cost averaging over the next 3 to 6 months is the most sensible path. And for the aggressive traders out there who want to ride the momentum, buying at current levels is an option, but you have to understand you are taking on the most risk.
So there you have it. We've just walked through a professional, repeatable process for figuring out not just what to buy, but when to buy. It's a system that balances that excitement about growth with healthy skepticism about valuation. You have the framework now. The only question left is, how are you going to use it to time your next investment?